So now we arrive at the part where we get to learn how to make money. So I'm sure you've been looking forward to this. Now you've learned how the markets work, the framework we use to understand markets, the way we read the markets contextually, the way we think about the other players and who's in control of the market. And you've also learned the very important part about risk management, about probabilities, about the accuracy and reward to risk continuum, expectancy, trading edge, R multiples, all of that, all of those things are key foundations for this. Right? If you haven't gone through those things, what you're about to learn now is not going to be nearly as powerful for you. Think of it like a house that's on weak foundations. If you haven't learned all that stuff that came before, if you haven't gone through it video by video, done the drills, really studied the markets on your own, implemented the risk management system in your own trading, set everything up, you're going to have a very hard time making money with the strategies, tactics, and execution that we are going to discuss now, because you just won't have the foundations for it. But as long as you've gone through the first part of the training, really got in depth into that, understood it to the very core, this is where the good stuff happens, because this is going to build on everything else. All those principles that you learned, now you get to use to actually learn how to make money in the markets day after day. So, having said that, let's jump right into it. Alright, so if you want to trade the markets profitably correctly, there's a certain hierarchy or pyramid of skills that you have to master. Now, the first and broadest of these things, i.e., the bottom part of the pyramid that's really the foundation, is strategy. Now, strategy, you can think of it in numerous ways, but really it just comes down to that strategy is what is your overall source of edge in the market. What defines opportunity for you in the market? That's what strategy is. It's the overall game plan that you'll use to tell you what represents an opportunity in the market. Okay? What represents a good entry and what represents a good exit. That's strategy. Now, of course, included in any good strategy is a good risk management system, which we've discussed before, right? So the best strategy in the world without good risk management, without correct position sizing, and then trade management would be useless. But right now we're focusing just on the strategic aspect of it, of what defines opportunity, and that's what strategy is. Well, one level up in the pyramid is tactics. Now, tactics is what you use to implement your strategy. It's what take this overall method and implements it on any given day. Alright? And then finally, the last part of the pyramid is execution. And execution, just like tactics implements strategy, execution implements tactics. Execution is the smallest part, the part where you actually hit the order button, get in and get out. The fine-tuning of the tactics. Now, right now this is just general and it might not be clear what these things mean, but you'll be able to understand them more. But so you have a better idea, let me give you an analogy from a couple different things in life that'll help you understand it a bit more. Alright? So taking the war analogy, for instance, the first thing that a general would do if entering war would create a strategy of how he was going to defeat the opposing side, the overall strategy of the whole war. Is he going to be offensive? Is he going to be defensive? Where is he going to put his troops? That kind of thing. Right? Then you go to the next step. His tactics would be any specific battle based on what he's seeing now that the other side's doing. He dynamically adapts. Those are his tactics. He still has the overall strategy in place, but now he's maneuvering within that using tactics to try to win specific battles. And then execution, this is the actual part that the soldiers do. You know, they have to fire the weapons. They have to execute the orders of their senior officers. That's the execution part. So it all fits in together. The biggest part is the strategy, then the specific tactics, and then the execution of those tactics. All right, so that's like a war example for those of you who are into war analogies. If you wanted to talk about sports, for instance, any coach of any given team, let's assume basketball, will have an overriding strategy that is his philosophy on how to play the game, of how you win basketball games. That's the overall strategy. But then the tactics will be, well, okay, now we're playing against this team tonight. We should adjust because they have a big player in the middle and we should, double team him. Those are the tactics of, okay, we have a general philosophy, but this is how we're going to beat this specific team tonight. And then the execution will be actually carrying forward those tactics on the floor. The players themselves, the defense, the offense, the shooting, they'll be executing whatever tactics are laid out. All right? And then finally, if you prefer an analogy from the corporate world, let's say, any company needs to have a strategy in the marketplace. What is it that basically sets them apart? What gives them a competitive edge in the marketplace? And why are they better than other companies? All right? Maybe their strategy is that they produce the same type of stuff but at much better prices. All right? That's their general philosophy. They have just the lowest prices. And then the tactics would be, now they're looking at their competition. They're seeing this particular one this week is doing this sale and they're trying to beat their prices, so maybe they'll drop their prices extra this particular week. Those are the tactics. And then the execution will be maybe like which particular products, by how much, when, that kind of stuff, the very smallest specifics. Okay? So I hope these three analogies give you a better idea of what this means in trading. In trading, you have the overall strategy, which defines your opportunity, your philosophy of how to make money in the markets, what gives you the edge, just like a company would have a competitive edge, or a general in the battlefield will have, the edge in the war. Then the tactics will be, okay, now the market is open. How is the market actually moving based on the current environment? And how am I going to implement my strategy based on these specifics of this day? And then the execution is actually, okay, getting in and out at this specific level. I hit the buy or sell order right now versus a little from now, or on this price versus that price. That's the execution. All right? So because this is the way the hierarchy works, naturally, we're going to start at the base level, at the broadest level, which is the strategy. First, you need a strategy to apply tactics to then execute, right? That's the base level. So this is where we're starting at now. And the question is, what is our strategy? What is the strategy we are going to teach you? And there's really a very simple way to define what we do in terms of strategy. And based on everything you've learned in your overall market framework, it shouldn't be surprising to know that our strategy for day trading is to fade key reference areas during non-trend days and get on board them during trending days. Now, what does fade mean? Fade is just a term that means you take the other side. So for instance, the market is moving down, hitting a major support or key reference area. Fading means you buy there, right? Because the market's moving down, but you're going against it, you're buying. But you're buying it at that key reference area. On the opposite side, fading the resistance area means you're selling at resistance. So really, our overall strategy can really be defined as simply as we look to fade key reference areas when we don't have days that are outright trending, we go against the move. And when we do have days that are outright trending, we try to get on board that trend. That's the broadest level of defining how we define our strategy, how we define opportunity in the market. Now, we do have more advanced things that we do that we'll get into later, but this is the basics or crux of our strategy. All right? Now, given this, what would you say would be the key skill or the key skills that you need to have? if this is our strategy, right, that you see right there in front of you, what do you think are the key skills you need to be able to implement this strategy? Think about that. If you want, pause the video, think about that a bit, and then see what I have to say. Alright, so I hope you've thought about that a bit, and let's see what the skill actually is. So as we see, the key skill to be able to do this is to use all your market understanding to determine what type of day we're likely to have and which are the most important reference areas. If we said that our whole strategy is to fade key reference areas when it's not trending and get on board the trend when it is, well, the first thing we need to do is to determine what type of day we have. Is it going to be a generally trending day or a non-trending day? That's the first thing. And then after that, it's going to be to determine what are the most important key reference areas. All right? I mean, this really breaks it down to its most simple form of what you need to do to trade our strategy. Now this is our specific strategy, and we're going to be getting in deep into everything from A to Z, all right, of how to do all this. And actually you have already gotten a lot of information about how to determine the type of day and determine important key reference areas, but we're going to build on that on a practical level and show how trades are going to happen at those areas. But before you do that, there's something that you have to understand. And that's that there are certain requirements for you to be able to have a strategy with an edge. These are general requirements that are not just of our strategy, but of any strategy you have. Okay, because you can take our strategy, you can take everything we're going to teach you now, and you can mold it into your own style, and we do suggest you do that. Right? Mold it to something that you're comfortable with. But regardless if you trade our strategy outright or you mold it into your own style, there's two major things that you need for your strategy to have an edge in the marketplace, to have a positive expectancy, as we've gone over before. And the two things you need are, one, good trade location, and two, economically viable exits. Now, what do these things mean? Well, let's start with the first one. Good trade location simply means finding entry points that give you the ability to clearly define a small initial risk. Alright? If you want a strategy with an edge, the most important thing you need to do is to find areas on the chart, areas that you can enter where you have a low risk entry point. A place where you can have a small initial risk and hopefully pretty healthy reward compared to that risk. Now, of course, small is a relative term. It really depends on your time frame. We're talking intraday, obviously, day trading, but even within day trading, there's different things. You can be looking for small moves, or you can be looking to play the bigger swing in the day. Regardless, you have to be able to locate good areas that allow you to put a small initial risk. And what this means is that it's areas that allow you to place a stop that's not too wide, but that also, if it's hit, legitimately tells you that the market at that point has invalidated your trade idea. That's what good trade location means. Bad trade location would mean you're entering a trade in an area where even if you have your stop level at a certain price, if it hits that price, it doesn't really invalidate any given hypothesis about the market. It doesn't, if that stop is hit, it doesn't prove that now, for instance, the bears are in control, the bulls are in control. It's just still in the middle of the chart and you're like, there's no real reason. It's just a random entry. Whereas good trade location means that if you're wrong and your stop is hit, something has changed in the market. And good trade location means that you were able to enter at a place that's close to the edge of a certain area that's a line in the sand. Do you get what I mean? You're not in the middle of nowhere trading. You're close to an edge of a certain area. It could be a key reference area, or it could be like a move out of a key reference area or something like that that's close. And we'll get into all this, but I just want to say this clearly. And there's some very important benefits to having good trade location. So let's take a look at some of those. The first benefit like we've alluded to, is that you get better reward to risk trades. When you have good trade location, when you're trading at the edges of key reference areas or at the start of trending moves, right, you're naturally going to have better reward to risk because the potential of movement of the market from that important area is going to be large in comparison to the small risk that you'll need to take that would invalidate your trade. So, and as we've seen, having big reward to risk multiples is something very important to having good expectancy. All right, trying to rely on accuracy alone is very tough. But the good thing about trade location is that it also gives you better accuracy. If you're just trading in the middle of the chart, not waiting for a good trade location, your odds of any significant move one way or the other is pretty much 50-50 anytime. But when you wait for a good trade location, and again, we're going to get into what is defined as good trade location, but I'm just trying to explain the concept of trade location altogether here. But when you have good trade location, you'll get better accuracy. If you're trading at those key reference areas, or you're trading at the start of trends or the areas where the trend is likely to continue, you are more likely to see a move in a certain direction than not, right? And that's what we want to do. We want to combine accuracy with reward to risk to have the best strategy possible. And we'll talk a little more about accuracy later when we get to the exits, because whether you realize it now or not, exits influence accuracy more than anything else. I know that sounds counterintuitive, but think of it this way. What would you have better accuracy at, regardless of what type of trade it was? A trade where you exited at 1 point or a trade where you waited to exit at 10 points? Which one do you have higher odds of doing more often? Obviously the 1 point one. So that means regardless of your entry, your exit is going to determine how good your accuracy is. Because with a 1 point exit, you can have 60-70% accuracy or more, but with a 10 point exit, your accuracy, no matter how good the initial entry was, is going to be low. But anyway, we'll get into that later. Just so you know though, good trade location, all else being equal, the exits being equal, will give you better accuracy. And then finally, the last benefit of having good trade location is that you have less of a chance of being stopped out by noise. Now what this means is that if you're just trading at any random place in the chart, which trust me, most traders do because of indicators and random setups that they follow, what ends up happening is that they enter, they put their stop and they think they're being very disciplined because they have a stop and all that. But the problem is that they get taken out by market noise. Since we're not at good trade location, we're not at a certain key reference area, or the context doesn't imply a larger likelihood of a move one way or the other, the market's just going up and down randomly in those areas, and their stop gets hit, but nothing is invalidated. No real picture has become clearer in the market, but they've just taken a loss. And so this is really important, and you combine these three, and these are huge. This will be the difference between a strategy that has an edge and one that doesn't, that loses. That's what good trade location is going to bring you. All right. Now, what about the other part of the equation, i.e. the economically viable exits? Well, your exits will only be economically viable if the commissions and slippage are a small percentage of your initial risk. Now, what does economically viable even mean? Well, it means exactly what it sounds like it means. It means that will you be able to survive? Will you actually have an edge? Is there economic viability if you keep doing what you're doing with your exits? And let me give an example what I'm talking about here. All right. Okay, so let's assume that you have a certain strategy. And in this strategy, you want to go for accuracy, right? And now we're simplifying just to prove a point. But let's assume in this strategy, you always do this. You look for trades that have 1 point stop and a 1 point exit, and you try to go for 60% accuracy, right? A lot of traders, most traders that I've ever met, including myself at the beginning, wanted to try to do something like this. You go, well, okay, if I had the same size losers and the same size winners, then all I have to do is be a bit more accurate and I can make money. I don't know any trader who hasn't thought of this. All right? Which is fine. It's not that it's wrong in and of itself. But the problem when you're day trading is that traders naturally want to do it on a small scale. And what I mean by this is they want to try to have a tight stop, like a 1 point stop, and try to get a 1 point exit. Or even lower, some of them will try to really scalp it. They hear scalping is the rage and you can have high accuracy in it. And so they try to do that. Well, what I'm going to show you here is that it's really not economically viable to do something like this, okay? And I hope this will instill it in your mind. So let's take a look at why. Let's assume you have $5 round term commissions and you're trading the S&P 500, all right? Just as an example. Well, what happens when you have $5 commission? When you have $5 commission, right, one S&P point is worth $50. So $5 commission is like 0.1 S&P points. So your real risk when you have a 1 point stop is actually 1.1 points. Okay, because when you lose, you're not only going to lose $50, i.e. 1 point per contract, you're going to lose 55, so it's 1.1. That's your real risk. But your real profit, when you do make that 1 point exit, is going to be whatever you made minus the commission. So it's actually going to be 0.9, right? So in reality, even though you thought you were having a 1 point stop and a 1 point exit, 1-to-1, in reality it's 1.1 point risk and 0.9 point profit. And so what does this do? Well, if you take 0.9 and you divide it by 1.1, what you get is 0.82, around there. Okay? This means that we have an 18% erosion in edge here. Why? Because we thought it was 1-to-1, right? 1 point stop, 1 point exit. So we thought our reward to risk was 1-to-1. But in reality, it's not 1-to-1. It's, what is 0.9 divided by 1.1? It's actually 0.82 to 1. And so instead of 1-to-1, we have 0.82, which means that it's actually 18% less than we thought it should be. You go, okay, well, would this still have a positive expectancy? Even though I had this 18% erosion based on the commission, would this strategy still have a positive expectancy? Well, let's take a look at that. So we see in this instance it does. You're profitable 60% of the time, and your average profit is 0.82 times the average loss, right? Minus you lose 40% of the time that average loss, and you end up with a positive expectancy of 0.09. So it seems like it's still fine. But here's the problem. There's also the issue of slippage. Now here's what I mean by this, and it's not the typical definition of slippage. See, slippage, if you don't know, means that if you're trying to enter or exit the market, sometimes you don't get the price you think you're going to get. Okay? So if you click buy and price is at 1300 and it's moving, you might get 1300.5. But even if it's not moving and we're standing still, if the market is sitting there at 1300, when you click buy, you got to get in at 1325, 1300.25. That's the next highest tick. So instantly right there, even though the market might be trading at the bid now and hitting 1300, you got to get in at 1325, right? 0.25, which means that now it's going to have to go through a whole point from up there just to get to your profit target, right? Not only that, sometimes when it hits your stop loss as a market order, instead of getting you out at your point, it gets you out a tick lower. Now in the S&P, it's such a liquid market that rarely happens, but in other markets it happens. So that adds to your loss at times. But then here's the key point that you may have never thought of. Even if you always use limit orders, okay? Let's say it's at 1300 and you want to buy, you don't try to reach and buy the offer at 1300.25. You wait till it hits you at 1300. Fine. And let's assume it's a liquid market like the S&P, you never have slippage on your stop. Fine. What happens? Okay, so you enter at 1300. All right? You want to get out at what point exit, which would be 1301. Well, here's the problem. You put your exit at 1301. But what ends up happening is that the vast majority of the time, for you to be able to get out at 1301, it usually has to trade through 1301. It usually has to go to 1301.25. Why? Because there's a lot of orders ahead of you, usually, and your order won't even get filled unless most of the time it trades right through it. So what does this mean? This means that if you're going for a 1 point exit, the vast majority of the time, the market actually has to move 1.25 points in your direction for you to actually be able to take that exit, right? And what does this mean? Well, this simply means that 60% accuracy that you've been assuming, maybe you've been paper trading or just looking historically at something, you think it's going to be 60% accuracy, but in reality it's going to be lower, because now you don't have to just go for 1 point. You're going to need to get about 1.25 points. And so maybe your accuracy will drop down a bit from 60% to, let's say, 55%. So assume it does go down to 55%, which is very logical because you need a bigger target now. And you will reach that bigger target a lower percent of the time, just logically speaking. Your expectancy would be something like this. We replaced 55 and we end up with around 0. Now you have no edge. In this strategy that seemed so logical, I risk 1 point, I make 1 point, I'm accurate 60% at a time, we realized that based on market realities of commission and slippage, and this hidden slippage, which means even if you don't get any slippage, the market still has to trade through your price and go a tick higher for you most of the time to get your profit, you end up with a strategy that has 0 edge. And that's assuming your accuracy stayed at 55%. If it actually went lower, you end up with a losing strategy. And so the whole point behind economically viable exits is that you have to make commissions and slippage a small percent of your initial risk. And how do you do that? Well, it's very simple. You have to have larger stops and larger exits. The point I'm trying to get at here is if you're day trading and you want to have an edge, we recommend having at least, in general, on average, every once in a while it's fine if you find the correct rate, but on average, you're going to need 2-point stops and above, and 2-point exits and above. I know there's a lot of trading teachers out there that try to teach, you have a tight stop, maybe less than 2 points, and then you go for half your profit, maybe at only 1 point. You're just killing yourself because those commissions and that slippage is going to be a high percentage of 1 point. Right now, that commission of $5 represents 0.1, which is 10% of your 1 point stop. Okay? And the slippage, meaning the fact that it has to go through your price most of the time to fill you, is a tick, 0.25 points. So now you really have 0.1 plus 0.25. The real erosion is about 35%. Right? You have 0.1 in commission and 0.25 in that slippage. So you have 0.35 out of your 1 point stop. But what if you had a 2 point initial risk? Well, this 0.35, which will remain the same, your commission is the same, the slippage is the same. Well, now instead of being 35% erosion, will only be 17.5% erosion. And if you had a 3 point stop, it'll be less than that. You see what I mean? So all we're saying here is that this is a thing that no one tells you about, that none of the educators talk about, which is the realities of trading. And that's why if you've ever tried those strategies that try to get you in and out of the market and you scale out a tiny little half a point or a point, that's why you'll never end up making money at the end. And if you've experienced them, you know that very well. Because quite simply, your edge in the market is naturally going to be small no matter how good you are. And when you erode it by 20, 30, 40% based on these small stops, you're going to end up with no edge or a negative edge. So this is just a warning. This is what you need to have a profitable strategy. You're going to need your stops and your profit exits to at least be 2 points and up. Okay? If you have 2 point stops, you can't be shooting at least for anything less than 2 point exits. Don't be taking your profits before that. That's what we're trying to get here. Overall, it's going to hurt your edge. And then the other point, like we discussed, is that you need good trade location. Combining these two, if you have economically viable exits and good trade location as the basis of your strategy, now you have the potential to have a profitable strategy. And like we said, our particular strategy is to fade key reference areas on non-trending days and to get on board the trend on trending days. And in the next session, we're going to teach you how we take that overall strategy and how we practically apply it to the markets on a day-to-day basis. It takes a lot of certain points of preparation, but once you learn those, you're going to be equipped with a plan of how to enter each day with the correct strategy, which then you will be able to apply tactics and execution to make money from the markets. So we'll get into that in the next sessions.